Great,
Let's
great.
do it.
All right, welcome everybody. Welcome to our quarter one market report. Thank you, KW agents, our guests, our vendors, people from around the world. Cody Thorup. I want to introduce my co-host here, the man, the legend, the owner of many automobiles, Cody Thorup. Welcome, buddy.
Thank you. I appreciate you having me.
That was my G-rated intro. I had a whole nother one ready to go. So
I appreciate you keeping that one to yourself this morning.
Cody's my partner. He is the director of sales Red Sign team. So you have a lot of transactions going through your fingers. You're in a lot of deals, and you're watching the market quite a bit. So thank you for being on. Gordon, you ready to roll, sir? Huge shout out, as always, to Gordon Payne. Gordon does a lot of the work putting these stats together. We are a self-proclaimed best market report of the state, but I do think this is probably the most comprehensive, all the different pieces of data that might connect to our industry put together. Thank you for joining us. And again, you can access all this after the fact. He does two things. He records the video, puts that on our YouTube channel. You can just go to kidofutah.tv. Go straight to it. But if you go to kidofutah.com, click on resources at the top right, agent resources, we have the PDF version of these quarter market reports. So it's cool, as we've been doing the last couple of years, seeing these slides just being presentations and all sorts of things throughout the state, which is great. Again, last time we did this was what, January? We were summarizing quarter four of 2023. And there was just a handful of things that gave us quite a bit of optimism. I think even the last several weeks, there's a few pieces of data. Unemployment just slightly went up, just a tad. Inflation has just really been sticky the last little bit, and kind of even just the potential delay of the Federal Reserve cutting rates. It was funny because I was in several groups in January, and I asked all of our realtors in the different meetings, what percent of the room thought that we would see rate cuts in the summertime, if not a couple rate cuts. And it was almost unanimous, Cody. It was like 99% of people voted that. And I think if we voted now, we might see a little bit more delay in the optimism, just with some of the changes that have happened the last couple weeks even. So
Yeah, I think how this has unfolded starting the year has been eye opening, because I think a lot of us, and I think we've been saying that for over a year now, that like rates are going to come down, and I'm under contract on a personal home. I tied up in January, hoping that rates would come down, and I'm supposed to be closing here the end of May, and I'm like, man, I don't know if trying to time that really worked in my favor at all, because rates are worse. So
yeah, yeah. Which again, one thing that we've learned is, mortgage rates don't immediately bounce when the rates raised or cut, right? It's always in anticipation of what the Fed's doing. Everybody has their crystal ball. They're looking into it, trying to predict and forecast what the Fed's going to do. And then we've seen rates even go up a little bit for sure the last week, almost a full, three quarters, maybe even a point. So we'll kind of go through some of that data. But here's just a summary. We went over some of this last time, but again, just going into COVID, coming out of the COVID pandemic, we went from kind of more of a small to a mid-sized state. A lot of internal to external growth. Our fertility went down a little bit. We went from a little bit younger to a little bit older of a demographic, less multicultural to more multicultural. But we went, something that I'm always proud about is our job, economy. Our economy, we have a lot more of conservative principles here in Utah, but we went from a strong economy to an elite economy coming out of that. The big one for us is we went from more of an affordable housing back in the day when I was slinging condos for 100 something thousand, back in the day. But we kind of came out of that pandemic as a more unaffordable housing market in the country. But let's kick it off, Cody, and just talk about UAR. NAR, no doubt, we start seeing the decline of realtors getting out of the business. We peaked NAR somewhere around the 1.6 million range. And again, this takes us just to the end of 2023. So they don't put out these numbers on a monthly basis. Even with some of the lawsuits and stuff like that, they're being even a little bit more stingy of what the realtor population looks like. So it's harder to gather that data. But my guess, Cody, is we've seen a significant decrease, even just seeing people going inactive across our 7 brokerages around the state. I would see, once we actually see the next version of this, we're going to see a pretty rapid decline like we did 2006, 2007. At one point, Gary even said that we'll probably lose maybe 300,000 realtors in the country, which I know that could be negative for some, but I think a lot of the realtor population could enjoy a higher sides per agent around the country and around the state. So I think some of the people not doing business, just non-renewing their license, could be helpful. You can kind of see it on a year to year, but 2023 we went backwards, UAR 2%. But again, I think I'm predicting a higher decline in 2024. But this is kind of the story, right? The sides per agent, as more people flood in the industry, and then that combined with the drop in closed units just because rates went up so much, UAR got down to 4.0 sides per agent in 2023. So I think hopefully we're seeing units go up just slightly, but then the amount of realtors that got out, I think we'll see a little bit of a pop on this sides per agent in 2024 as well. But here is all the real estate Cody sells individually. Total market volume, 2.24 right there. But I think the thing, Cody, that we've talked about offline a little bit is I think 2024 is just going to, in general, feel a lot like 2023 did. So if you hung in there, you did pretty decently in 2023. I kind of feel like that's going to be the environment that we'll see for, if not the majority of the year. Is that your opinion, Cody?
Yeah, I think, and we talked about it on our morning call as a team again this morning, is just, man, the little things when you go in your business like this and you feel the last 18 months, just the squeeze that's been going on, man, sometimes it's tiring to think, man, I just got to continue lead generating, having my conversations, following up with people. But I do agree, like that's going to be the name of the game this year. I think we're seeing that as a team too, that it's just, we're going to be steady Eddie. It's going to be feel very similar as it did last year. But we've got to keep putting our heads down and just keep having great conversations with our people.
Yep.
So.
Yep. So here's kind of the summary that we're going to cover today. This is just year to date from 23 to 24, the first 3 months. This is all of Utah stats. So you can just see in general new listings. We've seen more listings come on the market the first part of this year compared to last part, up 11.9. Pending sales, you can see, are up 4.8. So a little bit more under contracts, which is great for us. Closed sales kind of flatline, but up slightly 0.9. I feel a little bit more activity going on in April this year than I feel like we did last April. So I think hopefully we see even the closed sales pop up a little bit more. Days on market exactly where we were at this point last year. And median sales price, we did depreciate a little bit last year in Utah, and it seems like we've kind of already made that up, but we've gone from 470 at the beginning of last year to 490 this year. So 4.3%, percent of original list price received, 96.7%. So we're up 1.8% of getting that original list price. Could be that we're slightly paying a little bit more on that, but it's also maybe some better seller expectations on the original list price when they list that. But again, one of the challenges we continue to see with prices still being where they are, with rates trickling up a little bit, but affordability is backwards 8.4% this year. That's the story of the world. How do we build more affordable housing? But then home for sale, there's a little bit more on the market right now than we'd had last year, 1.3, but then month supply just trickled up just 0.1, so up 3.7%. So that's kind of our summary. We'll be journeying through all these slides more in detail, but that's our snapshot. So if you're new to this, Cody and I will be bouncing back between US data and comparing that to Utah data. So we go back and forth most categories just to bring perspective of where Utah is outperforming or underperforming the nation. But you can see year to date, that's kind of a rolling number, 4.2 million homes sold, existing homes sold in the country. A little bit better, and we're projecting a little bit more closings coming this year than we had last year. So projection for the end of the year will be 4.3 million. Again, the peak, we had a couple peaks, but 2021, you can see that was a peak of the latest decade. And then again, that hot market of 2005, 7.1 million in the country. But here's month to month. So you kind of see where we're pacing on this. Existing home sales, you can see we're pretty similar to where we were last year. But then you see annual new homes sold. And then on the month to month, this is new home sales. So we're outperforming where we were last year on the new home sold. At one point, the percent of new construction that sold out of all homes was a lot lower than it is now. We're selling a lot of new construction, a lot of these huge nationwide builders that still are poor money and they have a lot of big projects that they started several years ago. They're still selling those pretty well, for sure. Anything on home sales, Cody?
I just think we've been talking a lot about that on the buy side. That's where we've got to help with affordability for buyers. It's hard to compete with a DR Horton, on a FHA 5% rate. It's hard to compete with that on an existing home. So I still think that's going to be the name of the game this year. Getting our buyers, making sure as agents we're aware of what is the inventory, what do builders have, and do we have that in our arsenal when we're sitting down at buyer consultations to review that with our buyers to get them under contract and making sure that they can get in and in a more affordable situation.
Yeah. Well, and you can see the whiplash in the state of Utah. 2020 with 60,210 homes sold, and we dropped all the way to last year at 38,000. So pretty significant drop, close to that 40% mark. Good news is we're slightly above last year, so hopefully we're getting a little bit more closed units pouring on. But the average in the 21 years, so Gordon updated a lot of these averages over the last several years, but 21-year average is 43,000. So if we get a little bit more juice in us, hopefully we get back to that 43,000 average. But you can see month to month how we're pacing. January a little bit better, February a little bit better. March was slightly lower. Kind of felt like a bunch of stuff got pushed into April. So I think that's why April will shoot back up a little bit. But let's talk about home prices. It's funny, Cody, we've talked a lot that it's almost like macroeconomic wise, with how hard affordability's been in the country and in the state, we just needed to get back to that trend line on 4% appreciation, or even just kind of hover at a certain level of pricing for a little bit. And it's funny to see that showing up now. So you see, 2022, 2021, 2023, even year to date, 2024, we've kind of just been right there at that 386, 389 number. We are anticipating some appreciation this year across the country, maybe end somewhere around that 3.98, which is just that kind of riding that trend line. And then you see month by month, but then you also see that overlay of that yellow line, which is the mortgage interest rate. But at the end of March, we already got up to that 394,000 median purchase price around the country. But even the payment, right? We shot up payment so much. We went from 1,170 in 2021 all the way up to 2,027 in a 2-year period. And then already we're kind of right at that same level. So hopefully we can just stay a little bit at this level to let incomes catch up, but we still have that rate mechanism that could lower that payment pretty quickly if we saw some rate cuts. But here's Utah. Again, hovering around there, we ended at 484,000 in the state median purchase price. Year to date, we're at 490. If we were to keep that same 4% trend line, it just shows you how fast we got above that trend line, during COVID, post-pandemic, when a lot of that money was flooding in. Go ahead.
I was say, I think with looking at that slide too, it just makes me think. I think for a lot of us that have lived in Utah our whole lives, I've been in Salt Lake County for 32 years now, and really looking at what Utah used to be and where we're headed with the growth. Obviously this is a big conversation of just how housing is so expensive here in the state of Utah. But when we look at a lot of the stats, I know a lot of us as agents post about, how Utah's got such a great economy and we're number one in jobs. And, it just, we've got to help our clients and SOI realize like the new Utah moving forward is going to be an expensive one, having multiple incomes in the households and finding homes with basement apartments and, that I think really is going to be moving forward the new Utah. And do our clients know that? Do they understand that? And one of the things we've talked a lot about too, that younger clients or clients, kids, grandkids, what are we doing to help educate them on where the opportunity lies within the state of Utah? Because there still is opportunity, no matter the market, no matter there's always going to be opportunity. We've just got to educate people on where that opportunity is.
Yeah. And I think we did a great job keeping prices as low as they were for as long as they were too. Just when you have such a great economy that's constantly growing, we had great incomes. We had so many people moving in, we had a great, fertility rate. it was only sustainable for so long before that lack of inventory just kind of skyrocketed, which it did, right? Which again, 40% of inflation typically has to do with housing costs. And that's why as housing started going up in the country and in Utah, that inflation number just got out of whack a little bit, a little quickly for sure. Median home payment you can see across the state at the end of March was 2,576 at current interest rates on median sales price with a 20% down. So that's a principal and interest payment only. Again, up fairly rapidly, but a lot of that had to do with rates, but also in conjunction with prices going up. But here's an overlay of Utah versus United States. So the teal blue is Utah and the United States is purple. We were pacing right along with the country for quite a long time until 2017. You just start seeing that separation a little bit. 23, we kind of retracted because in the United States, we didn't actually depreciate last year, but in Utah, because we went up so fast, we did see prices come down a little bit, which got us a little bit closer. But here's a new one that Gordon threw in there. So you could see this is appreciation, just the straight percent historically. So you can see September 2005, the housing bubble, we went up to 14.51 appreciation. The Great Recession, you saw that drop, below the 0%, negative 12.75. But then, post-COVID, March 22, prices jumped 21.35%. And then May 23, just a tiny little correction right there, just due to the Fed raising rates. But even going back in time, you just see some of the history that we had, like February 79, inflation just, was all-time high. Prices went up 16.22%. Fed raises rates to all-time high by December 82, which dropped us back down to 0%. But those are all the back in the day, I had a 15% interest rate or an 18% interest rate. You see a lot of that just because the Fed was even more aggressive back then. Annual appreciation, you see the year to date, we're at 5.4%, but the projection is going to kind of level out right around 2.2. But if you look at the last 34-year average in U.S. home prices, we use that 4 to 5% number over the last 50, 60, 70 years. But even just pulling the last 34 years, again, reinforces that 4.44% appreciation, which is sustainable. So again, we jog too high or too low below that number, it just kind of puts an immediate impact on our economy. So hopefully we get back to that 2, 3, 4% pretty sustainable appreciation over the years. But that same average in Utah, over 20-year average, a 6.53%. So if you bought a home 20 years ago, every year it went up 6.53%. You can see 2023, we went 5.1% depreciation. So values on average went down 5.1. Already year to date, we've already rebounded up to 4.3. So kind of already wiped out a lot of that depreciation, which is, to me, a little surprising how fast that kind of already shot back up. But
yeah, one of the things I was going to say too is I am looking at a lot of the data nationwide too, Johnny. I'm pretty grateful for the economy we have in Utah when we talk home prices. There's a lot of reports coming out of Austin, Texas right now of what's going on and how much they're going backwards, and so it's a testament to the government here and how well that they have diversified the job market. And so we've seen that there's still a shortage of supply across the nation, but and we definitely feel that here in Utah. But I think, have positioned ourselves to handle a lot of the things that have been going on very well. And I think we've seen that with how fast we've shot back up and where the direction of pricing is headed.
well, let me ask you this, because I know you deal with a lot of files with a lot of the agents on your team. Gordon and I were just chatting about this. He's selling a duplex right now, and even with rates kind of shot up, he was surprised at the activity and showings and interest on this duplex already. But when rates went up so fast, it was like sticker shock. Like it was just everywhere. Everybody's talking about it. But I don't know what the time frame was, but it does seem like the buyer market, for the most part, has kind of just got used to where interest rates are right now. So it's a little bit less pain in handling that objection. Like, do you have any opinions on that?
Yeah, I think it is. I think we're finally to a point where I think a lot of people realize it's the new normal. I think for a lot of us, consumer side and agent side. So I think when you're pricing a listing, I think seller expectations are a lot more in line, because it's not like, hey, 4 months ago, like it was last year, I know, hey, my neighbor sold for this much more over list price. We've been in this new market long enough where I think sellers understand where they need to be to make sure they get their home sold. And then buyers also understand that, this is a new norm. I'm tired of living in my parents' basement. I'm sick and tired of renting. Like, I've got to get out. And so I think we are in a market that we still have an issue where the biggest, there's been big swings. We came out of winter, rates came down, and then we've shot back up pretty rapidly with interest rates. So I think that's a tough dynamic because, sometimes it does take a little bit to get buyers under contract, and pre-approvals can change drastically when we have rate swings like we've seen. But I don't think it's much of a, I'm just going to hang out and wait. Can I afford it? What are
Yeah.
my options? How do I get into a place and afford it?
Did you say you're living in your parents' basement?
No, no, no.
U.S. inventory, pretty similar to where we were last year. We're at 3.3. Again, that balanced market, 6 months of inventory. So if no more homes came on the market, it would take this many months to sell the existing inventory. With a little bit of the sales slowing, we saw that going up, but we're pretty solid from where we were last year. But here's a month over month. We're at 3.5. We dropped down to 3, bumped back up to 3.4. My guess would probably go backwards in April, May, as the season's heating up a little bit. I think some of the buyers that would have came out the first of the year kind of are waiting a little till springtime. So I think we might see some progress in that. Pending home sale index. So again, it's right there, kind of where we were last year. We still started off decent the first part of 2023, which I think is why you see 2024 year to date being down 9.54. But I think if that were to keep going, it'd feel pretty similar to last year again. But again, that 100, above that 100 index line is what we call an expanding marketplace. U.S. pending home sales index right here, up a little bit, 75.6, and they haven't released the March numbers yet on this one. So U.S. new single family housing units completed. 2021, it did feel like there was a lot of houses coming on the market, but in reality, we were actually just getting back to the level that we need to be building every year to cut into that gap and that shortage of housing that we have. Cody and I, we talk about apartments a lot. We have a project going that we've started doing with some apartments with Boyd and a bunch of other partners. Even the amount of apartment complexes that have just stalled the last 2 years is projecting to just complicate this whole shortage, right? We've been meeting with construction groups that build apartments. One prominent one that builds a lot in Utah, they were slated for, I think it was 15 or 17 entire apartment complex starts in 2023. Rates went up so fast that they ended up only starting 2. So you think about 15 apartment complexes not getting started because of just what's happened. I think that the collective compound of shortage of units is just going to get, it's a little bit of ticking time bomb kicking down the road, in my opinion.
Yep. That's my biggest worry right now is across. I've got a past business partner in Maryland that I talked to last week. I was in Georgia with some of the stuff we have going on there. There just isn't enough homes across the US. We keep kicking the can down the road, to your point. And that's one of my big worries. It's also what's helped prop up pricing is because we just still the supply and demand issue that we have, and there's just no easy fix, to solve for that. So
yeah. Which again, if 40% of inflation has to do with the housing costs, if we don't find a way to tap into that shortage, even if we get inflation because of rates being high and all that, we get that back down on the trajectory to get close to 2%. Rates start coming down, it could just speed up, and then inflation could just get out of whack again. So it's a complex set of problems we're going to have to be kind of dealing with, on a balance of prices going up too fast, but also eating into that inventory shortage. We'll have to figure that out. But a lot of just the year of an election, there's just a lot of things that get kicked down until we figure out who's president, So I think even some categories that might be changing or positioned to change over the next several months might even just get delayed till we see what happens in November. But here is Utah stats. So this is one we found right now, 2023. we're seeing a pop up from 28,000, but let's just look at the colors. So orange is increase in housing units. So that is more houses being built coming on the market. The purple is housing households increase. So that's either houses expanded that has to do with our fertility, but a lot of it has to do with our net positive migration. More people are moving in than moving out, which compounds that cumulative shortage. So we basically ended the year at 33,000 homes short in the state of Utah. And even just the forecast for 2024, we're going to see, what is that? Probably a 10, 11% increase in the shortage. So going all the way up to 37,000 short cumulative. And look at the progress we did make. When we peaked at 56,000 in 5 years-ish, we cut that almost in half. So it was going well for a while, but we're on that trajectory going up. I would even guess we're not going to figure out how to solve that in 2025. So we might even see another pop up in 2025. But here's county by county, the projected housing demand. Utah County new units needed 66,000 compared to the last decade, 2011 and 2020, 50,000 were built. And you see Salt Lake, the new units needed, Washington's up there, Davis. So showing index. So showing index has to do with a higher number means an average home receives more buyer visits in a given month. All index values are scales relative to the initial index of 100 since January 2014. So even that pop up of showings, right? So 197% just means the activity is increasing. Last March, we were at 223. So again, still pacing somewhat similar to last year. Annual months of inventory slightly went down from where we were last first 3 months of last year, 2.8 months of inventory. You can see on a month-to-month basis, the red 2.8, 2.8, 2.8. But you traditionally see as we get into those winter months, you see inventory going up a little bit, and then springtime it kind of cuts into it. New listings coming on the market. We are up 11.9% from where we were year-to-date 2023. But when you compare 22 to 23, we dropped, about 11,000 new listings that didn't come on the market, which, Cody, that has a lot to do with just a lot of sellers that maybe want to move, they want to change, they want to move up, they want to move down, but they're sitting on a 3% interest rate. And to go buy something even with a lower purchase price and what they'd sell with a double interest rate, they're like, why don't I just stay? It's cheaper to have a bigger house, right?
Yep. Well, I also think some of the dynamic, we saw a lot of people move during COVID. People were upgrading, they were getting that home office, they were getting that bigger backyard space because they needed it because we were confined to being at home. And so I think that's one of the other dynamics that it's hard to tell on a slide that's happened. We had so many households make a move because it was so affordable and there was a need during COVID to do it. And so part of it is you have a lot of people, they are stuck in a low interest rate. And so seller financing has been a big deal for us as a team, and making sure we're helping every seller understand what is the benefits and options that they have to take advantage of. And does that ultimately help get them into that next house and get them to make a move because of some of the things that they have for options.
Yeah. But even the percent, if you look at like 2022 out of the 62,000, like what percent of them was new construction versus now what the listings that are coming on the market, what percent is new construction? Drastic higher number of new construction listings on the market right now. These big builders that still just have so much inventory, these big projects of 500 or 1,000 homes that they were announcing a couple of years ago, they're still just selling, out of that inventory.
Yeah, one of the things too that we were talking to Edge about, for an example, is there's still so much pent up buyer demand that they've had to start raising prices because they are worried about selling their inventory too fast here, because they still have not ramped back up to what we saw in 2020 and 2021 for new starts. And so that is a concern from the builder side, is that they're still seeing, because they have offering great incentives or offering lower rates, they're seeing buyers just really lean into that as their option to make it affordable to make a move, and they're selling too quickly. So that's something to keep an eye on, with buyers, is helping them understand it is more important to get in sooner right now because of prices going up.
Yeah. Percent of new residential listings sold. So the blue's new listings, the orange is sold listings, and then the purple line is the percent of new residential listings sold. So 2020, 2021, it was a 90% chance, throw it on the market, put a decent price on it, it's going to sell. We were coming out of 2011, which it was a 50-50 odds of your home actually selling, but we're now about, right at that 75% number, that 1 out of 4 homes that list don't end up selling, which is a great stat, right? This is one that you should show your sellers, that you got to price it right so you don't end up being that 1 out of 4 homes that just never sells. You can see month to month, March, we actually ended at what, 63.6%.
One of the things I'm keeping my eye on too this quarter, Johnny, is one of the things that happened last year was rates took a dip. This time last year, April into May, we saw conventional loans loan rate get down to about 6%, and so we saw an uptick of just a lot of traction. That's where we saw some of the pricing tick up too, was a year ago. Now this year we've got higher rates, so it'll be interesting to see in this seasonality. The best time really for Utah market is now, and in the coming months it'll be interesting to see kind of what the sold stats and some of these numbers look like the end of this next quarter.
Great point. Utah average homes for sale at any moment. This is how many homes are for sale. Almost right there where we were last year. 9,190 is where we're year to date. 21-year average is 17,900 homes on the market at any given moment. These were the days I got in the business. 31,000. I remember that. You showed 45 houses to every buyer. They could wait weeks to pick their house. But again, 10,000 homes on the market, 9,000. That's still a lot better than where we were 2021 when there was, sub 5,000. It's just crazy how low of inventory that we got to. I think even coming out of that, I remember reading a stat that like 30% of buyers regretted their purchase, but they just felt like they had to buy because everybody else was buying. Prices were going up. We had homes for 30 offers on it at any moment. Here's month to month. You can kind of see pacing exactly where we were first quarter of 2023. Pending sales, again, up a little bit, had a little bit more under contracts this quarter than we did last year, 10,394, up 4.8%. So I think that's why we're projecting home sales to go up, because more under contracts means more home sales the next 90 days. Little less agents this next quarter, so I think we'll see that pop of sides or GCI per agent go up. Here's month to month pending sales. Again, March tends to be one of our best months, but I just think it wasn't a pop, so I think it'll just kind of be a gradual, increase over the springtime. U.S. average days on market, 36 year to date, up 11.5% from where we were 2023. 12-year average is that 39.3. We're just trending to a lot of averages, I feel like, Cody.
Yep. No, I think we can get back to a lot of averages. I think it bodes well for us in the industry. The more closely we can just get back to what the average is going to be good. Utah
average days on market. This does include the under contract period. 63 days. Our 13-year average, 54.5. A lot of those 40s for several years. Lowered that average. And then here's our month to month, 62, 67, 61, the first 3 months. And this is statewide. So again, depending on where you're at county-wise, this is just the blended average across the state, but this includes a lot of just rural counties. Some of those houses sitting for quite a long that might increase this average. But mortgage rates right now, end of the year, we finished at 6.81. With all those rate projections that we were going to see some Fed rate cuts in March or May or something, you start seeing rates go down a little bit. And then this whole last couple of weeks, you've seen them kind of trend back to where we ended last year at. That historical average, that green line shows us that we're right there at, 5.98 over the last 33 years. When you take the 80s with all those high rates into that average, it puts us up at 7.74. But we just had that run. We had that run. Sub 4, sub 3 even for so long. Here is annual average 30-year fixed. So year to date, we're averaging 6.75. Even 2021, we averaged that whole year probably sub 3%. Here's our monthly, a lot of volatility this last 6-12 months as everybody's trying to figure out what's going on. Data's getting revised. A lot of the data, this is the worst part for Gordon Cody, is we put these stats out, and there's some of these that are the most recent estimate, and then they'll go back 5, 6, 7, 10 years and kind of recalibrate some of their numbers. So every spreadsheet he has to go back before the quarter market board to see if there's any changes in any previous quarters. Or when they make a definition change on how they're counting a specific stat, they'll then go, retroactive, change all that data in the past. So just a lot of volatility, just specifically in this 30-year fixed. You can see the green, which is 15-year fixed, and then the 30-year fixed. Traditionally, you're about a full percent different, but again, 6.39% as of last week on a 15-year, 7.1. Again, we hit that 7 number. Is that a lucky number 7 or not lucky number 7? 80,
Not lucky.
Not lucky. 89% of mortgages have rates of 5% or less. 27% of them are 3 to 3.5. But look, 32% of all mortgages in the entire country are sub 3%, which is a lot of those seller holdouts.
Is that the latest update? Is that the latest update?
Gordon, this is the latest update?
That's the last one I've got from last quarter.
Okay. Welcome, Robert. Mortgage-backed securities held outright by the Federal Reserve started purchasing in January 2009. But again, as that the rate's been going up, or they've raised that Fed rate, the other lever that they pull is just how many mortgage-backed securities they own. And pretty much since the peak of March of 2022. So for the full last 24 months, they've been selling off about $400 billion of mortgage-backed securities. Which
And this is a form of
those.
quantitative tightening, so that's why you're seeing the lending standards getting tighter.
Yep, less money in the market to lend. They want to lend it out to better borrowers, so they tighten up some of the underwriting criteria to make sure the money's going to a little bit more of a grade A buyer. So if you have a lower credit score or any of those other categories, you might struggle a little bit more to get funding right now. But here's total Fed Reserve assets held. Again, we peaked at almost 9 trillion assets held by the Federal Reserve, and we've dropped about 1.5 trillion down to 7.485. And then you see that Fed funds rate also overlaying that. We just had that 3-year run at the Fed funds rate being at 0.
So cheap. To your point too, I think that's one of the other things that's hurting us with new starts, Johnny, is that things have gotten tight for lending. We talk about the apartment complex as an example. You have to have more cash injection and more money down into bigger projects right now because the appetite for greater risk on projects is less right now because of the environment we're in. So that's another thing again that's just been a little bit part of the dynamic that we're in, and it's hurting us in some ways.
Yeah, even down payments on investment properties, you're having to put more down to make it work. So even those are even less risky loans for banks too. So they're even prioritizing more down payments on those, right? And our mortgage people, kudos to them. I just think they're having to hustle a little bit more. They're having to be scrappy a little bit more just to get loans done in that environment. So here's the purchase index. So this index includes all mortgage applications for the purchase of a single family home. It covers the entire market, both conventional and government loans. Again, purchase index right there at the 150-ish range. Interest rate, big one to do that. Here's the purchase index on a weekly basis. So we've been in the 140s the last several months, but pretty much the same environment on the amount of purchase loans pretty much since they started raising the rates. But again, pretty much the last 12 to 18 months. Mortgage credit availability index, just like Gordon was just mentioning, almost in half from where we were on available credit out there in 2019, but we've dropped 7.63% year to date so far on mortgage credit availability index. And then a month to month, every month we're slightly under pacing where we were last year, right at that 100 is what we started out 2023, but we're at the 92, 93, so a little less credit out there. Here's refinances. Refinances is when you take a loan and you refinance it, right? That hasn't happened a lot the last 2 years. But mortgage refinance index covers all mortgage applications to refinance an existing mortgage. It is the best overall gauge of mortgage refinancing activity. Right there at 445, we were at 425. So we are starting to see a little bit of mortgage refinancing, but when we hit 7% last year, they dropped as low as what, 6% earlier this year. So even a full percent, that's maybe why we saw a little bit of increase in refinancing.
Yeah, one of the things we're trying to do too, Johnny, maybe a little nugget I would give is just to keep an eye on the closings you've had over the last 2 years and moving forward even into this year, because that's a great SOI touch, is to go back to those buyers who have closed with higher rates and to say, hey, great news, rates have come down. Can I get you connected with my preferred lender, and let's take advantage of that? Can I help save you some money? And
So
so
when you close, did you go log like the interest rate in your CRM that maybe is a trigger in your notes to let you know?
yeah, we've got a spreadsheet, and then we're trying to put that into our CRM too, so that we've got just a way to track it. And that's a great, anytime you can save people money, it's a great touch point in our industry to reach out.
Right. So let's talk about foreclosures. Savings has gone down, credit cards, debt has gone up. People's budget has tightened. Even people that have gotten raises, it didn't feel like it because you go out to eat, you go to the grocery store, it feels like you're paying double the prices, right? We've been watching this. Gordon and I put some of these data points together just to watch that foreclosure market. Let me hear and read this narrative that Gordon threw in here. A total of 95,349 U.S. properties had a foreclosure filing during Q1 2024, up 3% from the previous quarter, but down less than 1% from a year ago. While foreclosures remain relatively stable, Q1 2024's foreclosure data reveals a market in transition with slight increases in filings and starts alongside a notable decrease in REO properties. So still very low compared to what we've experienced the last 20 years back in the Great Recession days. But, the defaults, some of those things is worth watching every quarter. So this is some of the data that I actually really like to see, the new data that Gordon puts out.
And I think you're also going to see on that is not going to increase like we did the last, 2007, 2008, because there's equity in those properties. They've got a 3%, 3 to 5% interest rate, most of them under 4. They're going to let their credit card and car go before they let their house payment go, because rent is more than what they're paying on their home.
Yep. Different reason why we're in this market, but yeah, I agree. And you've got some of that car data and credit card data, so we'll go over that in a sec. But here's affordability right at that affordability index ratio, right at 100. Yearly housing affordability index higher HAI ratio indicates relatively more affordability. A ratio of 100 indicates that median family income is just sufficient to purchase the median price home. So the heyday post Great Recession, we were at 200 on that index. Less of your income was going to that housing. This has been in every news station, every newspaper, magazine, whatever. We're right at that 100 level. But if you were to jump forward 7-10 years, Cody, I just don't know how we would ever get back high above the hundreds. With the pending affordability issues that keep coming on the shortage of housing. So
no, especially not here in Utah.
Yep. Well, we are going to colonize Mars and the moon. Maybe that somehow alleviates the pressure. Robert, you raise your hand, sir. Welcome to class.
Real quick, did the previous slide for Utah say that our index is 76? It was way back at the beginning. I wasn't sure if I saw that right.
It's the next couple slides.
That very first chart. Okay, it's coming up. Thank you.
Yeah, Utah right there, 76, which is down 88.4% from where we started the year, but we averaged 71 all last year. Yeah, we're still 25 on the index, lower than the nation.
Do we have that comparison to the 70s? Like when we hear those people talking about like those high interest rates, can we compare our affordability index
I wish I could. We don't have complete data back that far here in Utah because they weren't combining all the MLSs.
Yeah, yeah. So the data
Thank
spot
you.
can only have one MLS's. Okay.
Thank you.
All right. Well, closing out that before jumping into investment, any final points, Cody? On the basic
Nope.
Categories. So let's talk about rentals. 80% of all single family rentals in the country are owned by mom and pop investors, which are categorized as they own 1 to 9 single family rentals. You see 14% are owned by regional investors. Those are people that own 10 to 99. Smaller national investor categories, the 100 to 999, they own 3% of all single family rentals in the country. And then institutional investors who own over 1,000 single family rentals owned. You've seen this hit the news a little bit. There's been some misreporting of stats. There's been time periods where institutional investors, there was like one quarter a while ago that institutional investors bought like 1 out of 5 or 1 out of 6 rentals that came on in that quarter, but that the institutional investors still own a very small portion. And there's constantly bills going through Congress that are trying to limit institutional investors in single family rentals. Go ahead, Robert Jeffson. Okay. Yearly, let's talk about rental rates. We got some new great updated data. Yearly average rental rates updated. These aren't the new ones, but you can see just average rental rates per county. But here's year over year change in regional and national asking rents. So this is interesting. 2021 at the end, all the way to 2022. That's where you saw that pop in asking rent. So orange is national, and then west is the purple. So we led, the nation in rents going up, but then look how it just flatlined and even decreased this last 12-month period. So if you own rentals, you were probably asking $100, $200, even $300 more in 2022 than you were in 2021 or 2020, right during the pandemic. But you've already started seeing a little bit of decreases in the rent asked. Yearly average rent growth, you can see 2022 pop there. Some of these categories, they don't update every year, but here's average rent increases. Weber County popped. Here is the federal housing assistance set by HUD. This is also 2024 updated numbers. But you can see like Utah County for a 3-bedroom, they set theirs at $1,766. Summit County 2331 for a 3-bedroom. Salt Lake County 2168. That's usually the approved amount for them to give in some sort of federal housing assistance. Here's your Salt Lake City average rent. Your 2024 year to date compared to 2023, slightly up by what, $30, $40. Here's HUD. They're behind on actual rents by about $300, $400, depending on the category. Cost burden. This is the percent in cost burden. This is old too. We went over this last quarter report, but pretty much affordable housing for renter households is a major component that's missing as well. Which you've got this. This is updated. So right now, shortage of rental homes, affordable and available for extremely low income renters. The people that live in the state of Utah that are in that lower income bracket, we're 43,000, almost 500 short on those rentals right now. Renter households, about 19% of all renter households, 19% are considered extremely low income, 62,625. And then the annual household income needed to afford a 2-bedroom rental home at HUD's fair market rent is 51,000. So 51,000 median household income. And then the average income limit for 4-person extremely low income state households. So 75% are extremely low income renter households with severe cost burden. So major issues. So a lot of the state Senate, state Congress, they're talking about this. Here is our United States total median rent growth. Again, that's where you've seen it just slightly lower than last year. So we ended the whole year at 1988. First quarter, we're at 1977. So we started going down towards the last half of last year, but already rent is a little backwards from where we were last year. United States total median rent growth. Here's your change year over year. Your median rent in the nation is kind of flatlined that last year, this last year. But if you look at a 2-bedroom, a 1 and a 2-bedroom, Gordon broke these out, were lower. So you've seen rent decrease. So they're charging less this year than they were last year. And then here's the US new build for rent, 2 or more units completed. 28 years below the 48-year average of new builds for rent. So a lot of just multifamily new construction that is built strictly for rentals. And then rental vacancy, Utah's purple, blue is the United States. Across the state of Utah, 2023, we ended at 5.3% vacancy. And then your teal blue, 6.5. So a little lower vacancy in Utah. But here's great. Thank you for pulling this. This goes to the Q4 2023. But if you're running rental analysis on any rental properties, and when you go to put that vacancy line in, here's your updated county one. So Utah County 8.2%, Weber County 5.1%, Salt Lake County 5.8%. And Gordon has worked his heart out to find out what the heck happened in Davis County to have that spike up to 13.9%. But Q4 2023 was just a huge pop in the vacancy rate.
Yeah, I talked to my property manager about this, and he doesn't exactly know what happened up there, but they've got a lot of rental units up there, and it's been pretty hard.
I was gonna add too, Johnny. I think that's one of the things we've seen as so many people have so much equity in their homes and such a low interest rate. When we look at that other graph on the percentage, we've got 89% or 5% or below. That's been one of the options that a lot of sellers have looked to do instead of selling the asset, is to keep it. We saw that great increase in rental rates during COVID, and we've now flatlined and gone backwards a little bit. And we can see that by talking to property management companies, ours as well. Just there's a lot more influx of properties to hit the market. And I think that's one of the options sellers have leaned into. And because the gap there and the cash flow that is available with an asset that they've owned for a handful of years and refinanced and took advantage of such low rates during COVID. So
as in, like, when you go to a listing appointment, you know, what they're going to sell it for now versus if they could wait for rates to rebound down a little bit and the amount of buyers coming on, closed units going back up, a little bit of that spur of activity, what they would sell their home for there, it makes more sense for them just to rent it for a year and a half or something like that. So you're seeing the surplus of rental units coming on.
Correct, which has affected kind of rental rates. We've seen that in the 1-bedroom, like I've got a townhome renting rooms out, and that's been one of the things. We have seen that go backwards a little bit because there is an influx of rentals.
So another great stat, annual average operating expenses per unit. You see Utah County, $450 a month, $5,400. So this doesn't include debt. So this is HOA fee, maintenance, management, not a capital improvement. And this doesn't include typically your debt. But you can see our highest is Cache County at $721 a month, $8,656. So I think the challenge, and Gordon and I commiserate on this, even we've had a bunch of great rental units that we had prior to even the shift, the market going up and down. So we have good rates, we had good cash flow, but even specifically the last 12 to 18 months, when we're looking at our investment portfolio, rents have just flatlined, if not gone down in a lot of those areas. But then the operating costs have gone up. Not utilities are up, energy's up, HOA fees. Every one of my HOA fees have increased. And then the other one's property taxes have gone up, right? Property taxes have gone up. And then if you even look at the insurance market, pretty much every one of even our condo policies have almost doubled in the premium costs. So now you're renting it for a little bit less, even though your mortgage payments fixed at a low rate, operating costs up, like pretty much it's almost wiped out a lot of net, operating income or cash flow that a lot of people have, even on great rentals they've owned for several years, right? Let alone when you look at a new rental with a current interest rate, it's just been hard to pencil, right? Which is one of the motivating reasons why you've ran out to Georgia, right? Just because purchase prices were still significantly lower, but rent was still somewhat comparable. And the other thing that you mentioned to me, for some reason, the operating costs and maintenance are a lot lower just because labor's cheaper. So you're able to find some cash flowing rentals in, states like that, right?
Yep. Yeah, my background being in construction for almost a decade, that was one of the things that's been eye-opening in comparing cost of repairs and maintenance items here comparative to over there. There's a greater need for work. We've got such a great economy. Labor costs here are just way higher than some other places in America. And so that does impact, to your point, what an asset looks like and how great it looks like on paper if you can get some of that maintenance and some of those costs down.
Yeah, what was it, the HVAC bid that you told me about? It was almost half of probably what it would have been in Utah.
Yeah, I've got brand new AC, brand new furnace. He's doing one today, $4,100 for a 2-ton unit, $4,100.
Well, because you're in Georgia, so it's because they're Atlanta Falcons fans, so they just don't know what they're doing out there, right? Just kidding.
Maybe.
Well, we've also
Maybe.
had such an expansion, like the airport, the prison. Now we're looking at the point.
Correct.
Until the point is completed, we're still going to be in that overemployment situation in construction.
Yeah. Yep. So let's talk about the U.S. economy. Gordon and I were just chatting about the last couple of days. It's like the tale of two worlds, or the tale of two cities. You've got the private market, the private sector. You got businesses, that type of stuff, and then you have the public and the government. And they're kind of, we are all one economy. But if you were to remove a lot of what the government's doing right now, the private market would be categorized as a full-blown recession. A lot of companies are laying off people, unemployment's going up. Even a lot of states with high populations like New York, California, the unemployment's just like shooting up, right? So more of those conservative states, a lot of the West, like Utah specifically, our unemployment job market's still doing great. But it's almost like the government continues to pump money in to keep the market propped up in a lot of different ways, right? And some of those is the government spending, right? So the government has spent a lot of money over the last 5 years, significantly in COVID. We can't find the stat. We've looked everywhere. It's almost like they don't want us to know, but they've pumped trillions of dollars into our economy over the last several years. And that has artificially increased gross domestic product, right? So the GDP's up because of just government printing money, going in debt, and creating, some of that fictitious economy a little bit. I can't remember the time period, but it was like a 6 or a 12-month period. GDP went up about $300 billion. So there's about $300 billion more of products and services sold in the United States. That same exact time period, the government deficit, the national debt went up $800 billion. So it's almost like we spent $800 billion for $300 billion of more economy. Robert?
I just put it in the chat. The increase in money supply created by the Fed from January of 2020 to March of 2022 was $16 trillion.
Crazy.
$16 trillion. It took from basically the beginning of the United States and the American dollar until roughly late 70s to get the first 6 trillion. And then we basically increased $16 trillion in 2 years, unprecedented. We've never done it. Just look at that chart and think of just the law of supply and demand and try to understand that, because that chart I just dropped in the chat doesn't make any sense.
Yeah, so you see real GDP, this is annual year-over-year change in the United States, 2.5, 1.9, 5 point, was that 5.8%? So you see our GDP growing, but again, like if the government slowed their spending, what would the decrease in our GDP look like? And it would be unanimous that they'd categorize us in a recession. And even Gary Keller at his vision speech, he said, don't be fools. We are in a full-blown recession in the real estate industry, right? Like the drop in productivity, everything that's been going on. Here's annualized by quarter, 4.9, 3.3. Even the rebound, quarter two, straight up just to that 35% was just a lot of that PPP money, EIDL loans, a lot of just government surplus, which has also held U.S. unemployment. The federal government, I think, employs 2 million people. And if they were making, profit-based decisions on the amount of employees, they would have to do a lot of government layoffs, which would dramatically catapult this unemployment up. But again, you know, they're almost sustaining a lot of government workers' jobs just to keep this unemployment number low. 3.6, you know, I think we trickled up to what, 3.8 year to date. And that's the job market unemployment number is pretty much the main reason why they're still not nationally defining us as a recession time period. But the 34-year average is 5.8, primarily just post-recession. A lot of that almost double digits unemployment. I think the last time truly that we were significantly above that double digits, the Great Recession, I think it was like 20-something% back then. But here's U.S. Unemployment on the monthly basis. You know, the high threes pretty much the last 6-12 months. Here is job openings, which I still debate this a little bit, but this is saying that there's 8.8 million job openings still in the United States. And I know there's still some job openings, but, you know, just even 2 years ago, I felt like there was a job wanted hiring, you know, at every single place that I would go to. And now it's significantly decreased, like maybe 10-20% of those businesses left was still looking. A lot of just retail, a lot of food industries still looking for people.
Yeah, I was gonna say, being on the front lines too, just having conversations with people, you know, 2 or 3 years ago, to your point, Johnny, I felt like there was a lot of people like, hey, I just got a new job. I took advantage, or we're paying more money. You know, that great resignation, they called it during COVID, where people were jumping around because there was opportunities left and right. I also don't feel like that's been as common, and it's been less and less of a conversation where you talk to Sphere and friends and family, and you know, there's a lot less of that, hey, I've just recently taken a new job, because people are staying where they're at.
Yeah, and that's what the next chart will show.
Well, and that's what I said too about the construction industry. It's shocking that we haven't seen a significant increase in unemployment in the construction industry, but even that apartment analogy I gave, 2023, that one apartment construction company going from 17 apartment complex starts, which each apartment complex start is at least $60 to $70 million of construction, down to 2 actually started out of 17. 15, say at 60-65 million, we're talking about $1 billion of construction not started from one company here in the state of Utah. So again, how many jobs were not created or lost just from that one company swing? But here's U.S. Census region job openings and job quits.
And this kind of shows over this last year, we saw part of these where people were still job hopping, and now we're below.
Yeah. And even that unemployment number, we were debating about this in our run through, me and Gordon, about just they keep, over the last couple of years, they keep recategorizing some of the, you know, part-time or underemployed or whatever categories, just to kind of still maintain a decent perception on the unemployment ratio, that's one of the challenges when Gordon has to keep going back and updating, because they redefine how that may or may not be counted. But here's U6, which should include underemployed, marginally attached, and discouraged workers. So you see even that has gone up about 0.4% just the last year, whereas the underlying one, the U3, only counts those who have looked for a job in the last 4 weeks.
And it doesn't include, over this last 6 months, we've lost 1.6 million workers in the United States. So they've been removed from this. So it's not really showing a true figure of actual unemployment. And a lot of those people are retired. We're at the height of the 65-year-olds retiring last month.
Again, here's month to month, with the U6 being the purple, U3 being the blue. Labor force participation rate is the number of all employed and unemployed workers divided against the civilian population. 69% of our able working bodies are in the market, 62.6% in the United States. Here's by age group, so 55 and older, which what you just said, Gordon, we would anticipate that might go down a little bit. More people are retiring quicker, but then 25 to 54 were almost all-time highs, right? 83.5% trickled up a little bit. So real wages, even though wages have gone up systematically every single year, when you take inflation into conjunction with that, it doesn't feel like we got any raises, right? So 2021, 2022, real wages year over year, your spending power just went down 2, then 1.6, but it's slightly up in 2023.
And, oh, there it is.
Yeah, here's our real average hourly earnings month over month. So you can see where we started the year, down 0.3%, flatlined, up 0.2. But right now, starting out the year, our money goes a little less far. They keep saying inflation's lower, but I swear my meal, when I go anywhere to eat or the grocery store, compared to 2 years ago, is 100% more cost. Crazy. Weekly payroll wages index of all employees, total private. So here's your payroll wages index. So here is actually the trend line of wages going up 4, 5, 6, 9, 8%. So let's jump
And
into
that doesn't include inflation. So that's why we're kind of seeing those two graphs differ.
Yeah. So if inflation hadn't gone up, people would be generally making more money, more spending power. So we'll go through a bunch of these, CPI, which is the headline. This is the one that usually hits the majority of news sources. It includes energy and food. So you just got to know the headline CPI includes energy and food. Core excludes energy and food. Energy and food are a lot more volatile. So I think that's why they started tracking that a long time ago on just what the baseline of goods and services outside of energy and food. Flexible includes, a few other categories, sticky, some of those categories that are just a little bit more or less flexible, I guess. PPI, PCE, we'll go over a bunch of these. Here's inflation. So here's monthly CPI. Again, the Fed targets 2%. 2% inflation year over year is what they determine sustainable. CPI, the yellow one, includes energy and food. Most of the headlines, right? We trickled up from 3.7 to 3.8 in the last month announcement. And then you see the core, which excludes energy and food. That one dropped to what? 3.8. Here's our inflation projecting 2025, getting us back down to the baseline. And even some of those reports about the Federal Reserve, they're not waiting to get to 2% to drop the rate. Jerome Powell kind of discussed this in one of his last briefings the last couple months. They want to just see a positive trajectory that they will get to that 2% before they start making some of the adjustments on that. So again, if we can just get back to decreasing inflation, it increases the likelihood of those Fed rate cuts. These are updated as of March 2023. The average car is 48,759. With Tesla's earnings yesterday, even Tesla's going to cut their car prices. But 1989, that same car was 15,000. But if you adjusted it for inflation every year, that same car is $39,000. So again, the real change from prices from 1989 till now is 24%. So cars are 24% more expensive now than they were back then. Gas, man, gas is such a political debated topic for sure, but gas is almost 50% more expensive than it was in 1989. Gordon, do you remember when it was sub $1 when you were putting gas in your car?
In California, yeah.
Your pricing in houses, again, 393 at the end of 2023. 1989 was 94,000, but adjusted for inflation, 240,000. 63% change, which again was sheltered by with rates going down almost collectively that same time period. So your mortgage payment in 2023 is 2,056. It's 825 in 1989, adjusted for inflation, 2,106. So mortgage payment, because rates are still on average lower than back then, that's the only good number on this. But then wages, here's another one. Our average wages, 34 an hour. 1989, it was 980. Adjust for inflation, 25. So our income is up 37%. But when it comes to housing and gas, it doesn't feel like it. pretty much everything's gone up, but some electronics, right? Like TVs, computer systems, cell phone services. That's where you've seen just the competitiveness in the marketplace and innovation of technology and manufacturing drop those prices. Everything else has just drastically increased the last 23 years. It says toys are down 72%, Gordon, but I buy a lot of toys for my little kids. It doesn't feel like it. Here is our consumer price index per category. So median home price. This is 12-month percentage change. So this is March 2024. This is live data. What's happened the last 12 months? Median home price up 4.3. Rent growth up 0.8% in the nation. Real median home payment 7.8, and then interest rates are up 4.3%. A lot of these other categories. Rent growth's up, electricity, natural gas is down. Go ahead, Gordon. You're on mute, sir. Gordon, you're on mute, sir. You're on mute. You're on mute. You're on mute.
Newbie. So what you see out of the actuals, how far the government's behind with the rent and the median home payment.
Yep. Yeah, so they're posting 5.7. Our actual is 7.8.
Yep.
So if you took the real data and put it in their CPI number, our inflation might have gone up a little bit more than their
Yep.
I guess, right?
Yeah, they're like figuring, especially on rent, they're almost 2 years behind on rent growth.
Yeah.
When they figure it. And that's why the HUD numbers are so out of whack for what the actual rents are.
Yeah. Okay. Here's your flexible and sticky CPI. Flexible is your yellow line. Your sticky, some progress on that, but it has flatlined the last several months. Here's your producer price index. Tell us what this is, Gordon.
Say that again.
Tell us what the producer price index is.
So this is the prices that the producers are giving to the grocery stores, etc.
So it's like whoever manufactures or creates the item, when they
manufacturers
sell it to the retail establishment, are prices up or down on that? So as a lot of the 2021, 2022, the prices being sold like at wholesale to the retail people, way up, but I think we're back down to those sustainable levels, even though we haven't gone backwards. Like there really is nothing that's going to be cheaper than it has been in the last 5 years. It's just going to slow down at the rate that prices go up, right?
And that's what people don't understand. Same thing with inflation. The prices aren't really going down. It's just improving. It's not going up as fast.
I think that's one of the biggest misconceptions I hear is when they say, oh, inflation's going down, they think things will be cheaper than they were last year. No, we're slowing the speed or the rate of growth of prices. Here's your personal consumption expenditures by quarter, up 2.8%. We have not slowed our spending down. Here is your market-based personal consumption expenditures, excluding energy and food, up 3.2% from a year ago. Average, where are we getting that money? If our money, our income doesn't feel like it's going up, we are putting on revolving consumer debt. We went from 1.26 billion. We've already increased to, what is that? $40 billion on credit card debt increase over the last, 6-12 months. Here's your federal debt. Where did we learn that from? It was from the government. They're really good at putting things on debt. We went from 2022, $30 trillion to $32 trillion. It was a $2 trillion increase in our deficit in a 1 year period. We're on the same pace right now. Here's our total average. So this is all of our GDP, all of our gross domestic product, our services, our product. What is the number that all that sells for? What's our total revenue as a country? And then what is our debt? What is our debt? And they give us a ratio. So right now we've been floating around that 120% average public debt as a percent of our GDP. So we have more debt than we have GDP in a year. So if nobody made money and all things that we sold for prices just went strictly to pay off our debt, we wouldn't pay off our debt in a year, right? And if you do research on this, on countries, you get above the 120% number, it's not good at all. Like it's a very bad number to be at. So somehow we just keep hitting that 120% and then bouncing off at the last little bit. There's only a couple countries on the planet that have survived being above that 120%, collectively. And like Japan's one. I think Japan's at what, like 300% debt of their GDP. Like Greece is a good example. When they start getting up there, that's where they start having a lot of economic challenges. Other countries we worried about, like what'd you say, like Russia, China, like Argentina, they kind of just stopped putting that number out, which probably means they're well above that 120%.
Well, and if you look at Japan, they've had negative rates for so long just to get their GDP back in line. And this is I think this is actually their first quarter that they've got a positive.
Yeah. Which is funny because some of the negative things that we've talked about today with our economy, we are still in a better position than like 98% of countries in the world economy. So even as some of the challenges that we've had, we're still in a lot better shape because a lot of these other countries, if you have any sort of money or wealth, where do you want to put it? And it's still in the dollar or real estate or assets in the United States.
Well, and you see what's happening over in China right now with their housing market and the stuff that they're manufacturing. A lot of that stuff is coming back over here to North America. The lower stuff is going to Mexico. The higher end stuff is coming here. That's also going to increase the inflation. It's going to be inflationary for us for the next little bit, but it's also going to be a great growth story for the North America in general.
Yeah. I think Scott Galloway said this on Monday's podcast, but he said that China's like housing market and their debt on their housing market, they have 3 times more debt leverage on their real estate collectively in their country than we did pre-Great Recession. So they have some of their big companies that have already been in the news for defaults and stuff like that. They're in a rough spot with their debt on their real estate.
And I also heard that they've got more empty housing than we have population.
Yeah. The shrinking population countries too, for sure, are in a challenge. So again, here's our annual personal savings rate of disposable income, 3.9, 4.5. Average deposits. So this was a good sign for us. Again, when some of that COVID money was going out, when anybody was getting stimulus or child tax credits, they were immediately socking it away into their bank accounts. And that's why commercial bank deposits went up. Then we started spending it. We've been in the negative the last 2 years. So Q1, the fact that we're up 3.3% deposits at the bank are hopefully a good sign that we're changing some of our behavior on debt, whatnot. Here's your durable goods, new orders average in the millions, slightly down, right? So this typically projects, these are manufacturer orders, forecasting future retail sales, right? So you got to order it before it goes to sell. We're down a little bit this year. So I think a lot of those retail markets, I keep seeing news reports about, like even Express, they're closing like 100 stores around the country or something. You've heard of a few more retail bankruptcies coming. Here's your purchasing managers index, above 50s expanding. But here's your month. So this is March 2024. This is a good sign. We've been in contracting or slowing the last several quarters that we did this. But Gordon pointed out this morning that this is a positive sign that you're starting to see these things say growing, increasing faster. And then your advanced retail sales percentage change year to date. We are kind of flatlined from last year, 1.3%. And then here's your US index of consumer sentiment. So this is kind of just overall how consumers are feeling. 2023, we got down as low as 65. We're popped back up to 77. And then Gordon was able to find the data back to 2020, specifically for the state of Utah. We kind of been pacing with the United States, but we finished at 80 on the index of consumer sentiment. Here is month by month. Again, Utah going back to 2020, but a little bit better than we were going into the winter. Winter was just a little unpredicting. The holiday season, I know we're still celebrating holidays, but I think we're all kind of concerned about what next year was like. Now that the sun's back out, It's gone up a little bit. Here is your misery index, which takes inflation rate and unemployment rate. A lower number is better because inflation trickled up a little bit, unemployment trickled up a little bit. That's why you're seeing this number slightly going down on the index year to date 2024. Here's month to month. Let's try and look at Utah. A bunch of these are updated again. Ninth most favorable annual employment, Utah 1.9%, US 1.8%. First highest labor force participation rate. We got a lot of workers in Utah. Second lowest poverty. Second highest median income. Still the largest household size. Cody, how many kids you got?
Only three. I'm trying to catch up with you.
Plus you have 2 adults, so 5. So see, you're crushing this. Thank you for your support. Here's year over year industry change, job change by industry. So natural resources and mining's up, construction is up. That still baffles me a little bit. Maybe it's quite a bit of lag, but you're seeing information, a lot of financial activities and businesses, those have shrunk. You're also seeing unemployment rate, higher unemployment rate. Remember Utah geography? What county is this? I don't remember. But you're seeing still a lot of the main metropolis areas, a lot of population still in that almost 2% range. Here's your change in non-farm employment. 1.9, 1.8 increase in employment. Here's your yearly unemployment. Utah's the bar graph, 2.8, still incredibly low. This is very positive. For the most part, everybody that wants a job has a job. Monthly, still hovering around those high 2s. Health of Utah's industry, you want to be in the far top right. And who's our top right? We got government right there. They're expanding. Here's our quarterly gross domestic product by state. We're up 6.1%. You're seeing Nevada. The lighter the color, the better they're doing. Here's our GDP, again up. What's that? 5 billion. We're up 23 from 22. Here's our year over year change. Personal income growth. We've been outpacing the United States for what? 5, 6, 7 straight quarters. Utah's up 6% on our personal income growth, 4.7 at the nation. And let's try and hit construction and then we'll wrap it up. So US single family home starts. Again, 2021. Across the nation, we were doing good, but we've dropped back below that. And I think 2024 is going to show probably a pretty significant drop. Here is Utah housing starts by month. So the orange is your single family building permits, and then purple is your total. So that would include your multifamily and everything. Our yellow, we've been on a downward trajectory, as well as the purple. Look, even just a year ago, total building permits in March of 2022. So this was 2 years ago, 3,500. We've dropped sub 2,000 at the end of the year. Here's our housing starts, single family building permits polled, and then total building permits polled. Look at that drop. 2 years dropped, what's that, 57%? And then US price index of new single family houses under construction. So just the escalation of prices, appreciation of prices that are under construction.
At least that's slowing down a little bit now. I mean, look at that jump from 21.
Yeah. New multifamily under construction. This is US price index increases. Just hard to build stuff for anything cheaper, right? So the fact that they were to slow that down, even though prices are still going up, that's hard. But here's your builder confidence index. 21-year average is right at that 49.66. We are right there. We are right there at that 21-year average. We're up 16%. But if you look at the month over month, 51, 51, it's almost like every November, every October, the last 2 years, it was the lowest because of the unpredictability moving into the wintertime. We get out of the wintertime, pops back up. So we're back at 51, kind of pacing above where we were. You know, they were in the 40s. So I think a lot of builders are feeling a little bit better about building this year. And then total debt balances, delinquencies, we'll just try and hit this. But here, total debt balance and its composition. So trillion, 17.5 trillion debt across the United States. Student loan is the red, big chunk. Credit cards, yellow. Auto loans is gray. Your home equity revolving, and then your mortgage. A lot more mortgage debt. Here's your mortgage originations by credit score. So as it gets more tight, you're seeing some of these grays, yellows get cut into, but even just green credit scores, which also could mean they've got more cash, maybe more wealth. So even a lot of people with more money or good credit, they've kind of held off more. That's almost been cut in half. They're kind of in a waiting time frame, which makes sense. Auto loan originations by credit score. Everybody needs a car, but here's total debt balance by delinquency status. So red is severely derogatory. Orange is 120 days late. Yellow is 90 days late. But here's a great one. So I appreciate you adding this one, Gordon. This is percent of balance 90 plus days delinquent by loan type. So you're seeing over the quarters, you're seeing credit card delinquencies go up. You're also seeing the autos go up, right? But clearly student loans, that's all political, and that's probably not going to change for what, another year, Gordon, you said?
Yeah, because it's not being reported to credit until 2025.
They're still
So we're not going to see much of a change there unless it's private student loan debt. But the big ones, I think we're going to see a pop this quarter because this is only through quarter 4. We're going to see auto and credit card debt go up. That they've already been talking about that, what they're expecting, and the write-offs that they're expecting at the banks as they're reporting this quarter's profits.
Like I said, people have fixed rates, 3%. They're staying in their homes. They might have equity, so it's flat line, zeroed out almost. But yeah, credit cards, cars, you're going to significantly see that up over the next couple of quarters. And the number of consumers with new foreclosures and bankruptcies. So green is foreclosures, and then bankruptcies is red across the nation. But look right here. So this is leading into the Great Recession. Just you saw bankruptcies skyrocket. And then what followed them over the next 2 years is just the lag of the foreclosures. So as soon as you start seeing bankruptcies potentially going up, it's only a matter of time till the foreclosures start coming up, which is the risk on real estate prices. But again, we have a lot different mortgage market coming into this one. And then third-party collections are going up. So average collection amount per person, and then proportion of consumers with collections. So even though that's low, you're just seeing the average amount go up. And that's it. Cody, final thoughts.
I was going to say to add to this, I've got a deal going on right now where somebody's cashing out because they've had an asset, and they're cashing out to pay off all of their loan debt. So they're getting out of an asset, going to go rent for a little bit to be able to cash out and get away from some of those things that are chasing them. So it's interesting, but I think we'll hopefully see some of that stuff go on because of the equity that are in homes. But last comment would just be, I think there's still opportunity in the market we're in. I know some of these things can be negative or viewed negative. I think as agents and in our industry, what are we doing to educate our clients, and where are we spending our time every day in our business? Are we allocating it to lead generating? There's still a lot of people that are going to be motivated to make a move in the coming months, weeks, and as agents, we've got to do a really good job of keeping them educated on the market. I would encourage people to use these, include those in your listing consultations, your buying consultations. This is something that's really helpful with helping people understand where the data is. It's when you can provide data to help people make educated decisions, it becomes very helpful, and you become the person that people really lean on and go to when they're looking to make a real estate move. So these are always just great slides to make sure you're studying and reading up on every quarter.
Yeah.
And it's especially helpful when they still think it's last year and they want to list their listing unrealistic.
Yeah. Yeah, I had, people come to me, all right, everything you know about the market, what's your advice for me? And I think I have 3 pieces of advice that I'd like to just quickly mention here at the end is like, number one, I do see unemployment going up. I see job openings going down. I see people just working hard and being happy in their jobs being mandatory the next 12, 18 months. Just enjoy it, go to work, keep your job, keep your employer happy or whatever, real estate agents, go to work, put the time in, all that. Just keep your income and just stay positive in the workforce. I think number two, you have to pay attention to your budget, decrease your spending, delay big purchases. If you're thinking about going out and buying your BMW, maybe you need to chill out a little bit, you know, just like hone in your spending. And if you can get to the point that you're living below your means in this environment, those are the people that always end up owning all the incredible deals and assets coming out of this, you know, type of economy. And then the third one, the people that have, you know, a little bit of wealth, money, savings, or whatever, people need to make sure when inflation's the risk, you want your money to be in as inflation protected assets as possible. Like when inflation goes up, stocks go up, housing goes up, right? And the people that have owned assets versus not having them or just keeping your money in a savings account, those are the people that the economy is just outpacing and their money's shrinking, you know. So I still believe in reserves and savings, but having your wealth in inflation protected assets is important. Gordon, any final comments from you?
Yeah, I was having a conversation with my cousin's husband this last week, and he was referring to what happened to him. I mean, he's in his 80s right now, but what happened to him during the 70s, and he said in that time frame, inflation was the best time for him. He was able to buy several rentals, and his income went up because he was owning assets. And those people that own the assets are going to be the ones that do well during this time frame as we expand more.
Yeah, I agree. Cool. Anything else, Cody?
Nope. I think these are great. Hopefully all of us are using them.
Okay.
Appreciate you.
Well, have a great year. It will feel a lot like last year, but just keep cranking, make calls, lead generate, and close some deals. Thanks for being on the call. And as always, we post this on kwutah.com and kwutah.tv. So thanks for joining us for our market report.
Thank you.